Thanks for clicking. Canada is determined to eliminate high inflation and return to the Bank of Canada's 2% target range. This according to a new letter penned by Bank of Canada Governor Tiff Macklem in the National Post. The letter from Governor Macklem came on the heels of the release of Canada's inflation rate, which came in at 7.6% for the month of July, down from June's 8.1%. While prior to the release of the 7.6% inflation rate, many had hoped that cooling inflation, due in large part to gas prices, would induce the Bank of Canada to slow down the pace of its interest rate hikes. The letter by Governor Macklem doused any hopes of a slowdown, with the Bank of Canada expecting inflation and interest rate hikes to remain elevated for the foreseeable future. Given rising prices and higher cost of borrowing, this is definitely not the news that a lot of Canadians were hoping for.
Well, that makes me sad.
So what I want to do today is go over Governor Macklem's letter, take a look at the good news and the bad news for Canada's inflation rate as outlined by the governor, and then take a look where the Bank of Canada governor thinks our inflation rate is heading. As we'll see shortly, the Bank of Canada is planning on more rate hikes, which will have a big impact on Canada's real estate market and its economy as a whole. We'll obviously have an update out on those rate hikes on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into this letter. Governor Macklem begins by saying that although Canada's inflation rate has shrunk in the past month, it remains far too high.
He's a genius.
However, the good news is Governor Macklem says Canada's inflation rate may have peaked, with gas prices, commodity prices, and global shipping costs having all fallen from exceptionally high levels. Indeed, much of the decline in our inflation rate that we saw has been attributed to falling gas prices, which fell to 35.6% on a year-over-year basis in July, down from 54.6% year-over-year growth in June. So, says Governor Macklem, that's the good news. However, and not like this is going to come as a surprise to many viewers, the bad news is that higher inflation is likely to continue for some time. While Governor Macklem acknowledges that supply chain issues, global tensions, and volatile commodity prices remain a threat to the inflation rate, he spends a much larger portion of the article discussing Canada's overheated economy.
I got a lot of problems with you people!
With Canada's economy now fully reopened, Governor Macklem says Canadians are demanding far more goods than businesses can provide, and this is classic demand pull inflation. Far too much money chasing far too goods. If 10 of us show up at a restaurant all wanting steak, but the restaurant only has 5 steaks, the 10 of us are going to bid up the price of the available steaks until only 5 of us are able to afford that steak. That's classic demand pull inflation, which is what Governor Macklem says is going on in Canada right now, on a much larger scale, but you get the idea. As such, Governor Macklem says Canada is experiencing broad-based inflation, with the price of goods that make up over half of the Consumer Price Index rising by over 5%. This is a big shift from the Bank of Canada's focus on supply chain as the main driver of Canada's inflation rate, now focusing almost solely on the demand in Canada's economy. As such, Governor Macklem writes that the Bank of Canada is raising rates and is going to continue to raise rates to get Canadians to slow down on the spending. Governor Macklem then points to the housing market as an example, noting that as housing sales slow down, demand for renovations, demand for appliances will slow down as well. Similar to the steak example, if there are 4 of us who want renovations done and only one contractor, all 4 of us are going to bid up the price of that contractor, which is going to raise up Canada's inflation rate. However, if the Bank of Canada makes it even more difficult for 2 of us to get renovations by putting the cost of borrowing on our secured line of credit exceptionally high, that is going to slow down demand for that contractor, which should put a lid on how much that contractor can charge from the remaining 2 of us who are still in the market. While Governor Macklem acknowledges that these rising interest rates are going to cause some short-term pain, especially with the price of goods rising, he notes that in the long term, this is what is best for Canadians, as higher than normal inflation, as continued elevated inflation, will be much more difficult for all of us in the future if left unchecked. So, in summary, the Bank of Canada has shifted its thinking, obviously moving away from short-term supply issues, commodity prices, global tensions, etc., and focusing more on demand problems within the Canadian economy. And as such, as written by Governor Macklem, they are going to continue to raise interest rates as a means of slowing down the spending of Canadians. And it looks like markets have already caught on to this fact, with some already predicting a larger rate hike in the September announcement, and money markets already expecting the Bank of Canada's benchmark rate to have risen to 3.75 by early 2023, despite previous predictions that the Bank of Canada's rate would top out at 3.5%.
I've been saying it for 10 damn years. And I've been saying.
So, according to Governor Macklem, the Bank of Canada is going to continue to raise rates to get a hold of this inflation rate, despite any short-term pain that might be done to the economy, and it looks like the markets are already factoring this in, predicting another large rate hike in September and even more rate hikes to come, larger than the previously anticipated 3.5% top out. How high the Bank of Canada will go on interest rates obviously remains to be seen, but we will continue to have updates out on those rate hikes on this channel. If you want to get those updates, make sure you click like and subscribe, but for now, thanks so much for watching.